The U.S. national debt has exceeded $38 trillion. This milestone visually demonstrates the rapid increase in U.S. debt. The debt clock serves as a stark reminder of the accelerating debt accumulation. This level of debt raises concerns about the adequacy of conventional economic management. Such a threshold may necessitate reevaluation of fiscal strategies. Politicians and economists engage in debates concerning spending cuts. Economists issue warnings about a potential looming economic crisis. The public tends to concentrate on traditional solutions to address economic issues. These conventional solutions may prove inadequate for resolving the underlying debt problem. This focus on insufficient solutions highlights a gap in addressing the core economic challenges. Financial repression is a government strategy implemented to reduce debt burden. It aims to erode the purchasing power of currency over a period. This erosion reduces the real value of government obligations. The strategy is often implemented quietly and gradually. It benefits the government by decreasing the cost of its debts. Financial repression acts as an implicit taxation method. It effectively transfers wealth away from the private sector. The recipients of this wealth transfer are typically government entities. Savers, retirees, and wage earners indirectly bear the burden of this wealth transfer. The U.S. faces structural insolvency by late 2025. The debt-to-GDP ratio is projected to reach approximately 125%. This level indicates a severe imbalance between debt and economic output. Interest payments on the debt will exceed defense spending. Interest payments will also surpass Medicare expenditures. This situation leads to fiscal dominance, where debt management dictates economic policy. The Federal Reserve is shifting its focus from combating inflation. The new priority is protecting the Treasury's financial stability. This shift is driven by concerns about the national debt burden. Raising interest rates is now constrained due to the potential impact on debt repayment. Following World War II, the United States faced substantial national debt. One strategy employed to reduce this debt was financial repression. Financial repression involved capping interest rates at levels below the prevailing inflation rate. This policy effectively transferred wealth from savers to the government. Savers earned less on their investments than the rate at which prices increased. This method allowed the U.S. government to reduce its debt burden without raising taxes directly. Post-World War II financial repression strategies are less effective today. A key difference is the increased mobility of capital in the modern era. This mobility undermines traditional methods of financial control. New tools and approaches are needed to implement financial repression effectively in this environment. The One Big Beautiful Bill Act is designed to increase the national deficit. It aims to stimulate the economy through fiscal measures. The goal is to accelerate nominal GDP growth to 6% or higher. This growth target is a key element of financial repression strategies. Financial repression relies on a differential between nominal growth and interest rates. Nominal growth is artificially inflated through policy. Interest rates are kept artificially low or constrained. This gap facilitates debt reduction over time. The inflated growth and suppressed interest rates erode the real value of the debt. Inflation is the process where the general price level of goods and services in an economy increases over a period of time. Inflation reduces the real purchasing power of money. Inflation serves as the mechanism by which the real value of debt is eroded. This erosion benefits borrowers, who repay debts with money that is less valuable than when it was borrowed. Governments often need to issue large amounts of debt. To keep interest rates low during debt issuance, governments require reliable buyers. Stablecoin regulation can ensure a consistent demand for government debt. This regulation effectively creates a guaranteed buyer base for government debt offerings. The Genius Act is designed to establish a regulatory framework for stablecoins based in the U.S. The act aims to integrate the crypto ecosystem more closely with traditional financial systems. It effectively transforms stablecoins into a funding mechanism for the U.S. Treasury. This integration has significant implications for the future of digital finance and government fiscal policy. Stablecoin issuers must maintain reserves to back their digital currencies. These reserves are mandated to be a 1-to-1 ratio with the stablecoins in circulation. Acceptable reserve assets are restricted to cash or U.S. Treasury bills. This restriction creates a mandated demand for government debt instruments. The forced demand impacts the market dynamics of U.S. Treasury bills. This regulatory framework aims to ensure stablecoin solvency and stability. Artificial demand can suppress yields, irrespective of inflation levels. This suppression enables governments to borrow funds at reduced interest rates. The mechanism involves creating an artificial increase in demand for government bonds. This increased demand drives up bond prices and, inversely, lowers their yields. The economic system shifts towards national capitalism. In this model, the state plays a central role in directing capital flows. Capital is channeled based on state objectives rather than pure productivity. This contrasts with systems where capital naturally flows to its most productive uses. State influence can redirect investments to specific industries or regions. The primary driver is national interest, as defined by the state, not necessarily economic efficiency. Regulatory reforms are influencing banks' asset allocation strategies. These reforms incentivize banks to increase their holdings of Treasury securities. Treasury holdings are often perceived as safer and receive preferential regulatory treatment. Increased Treasury holdings can lead to a crowding out effect on private sector lending. Banks may reduce lending to businesses and individuals to accommodate Treasury investments. This shift in capital allocation can potentially impact economic growth and private sector investment. Credit steering involves directing financial resources towards specific industries. Strategic sectors such as defense, energy, and semiconductors are often prioritized. This directed lending can lead to market distortions. Resources may be misallocated, hindering natural market dynamics and competition. The Federal Reserve shifts to a supportive role. Liquidity provision becomes a primary function. This contrasts with maintaining monetary independence. The Fed now acts more as a facilitator than an independent controller. Financial repression can lead to negative real interest rates. Negative real interest rates penalize individuals who save money. Retirees on fixed incomes experience a decline in their purchasing power. This situation results in a subtle redistribution of wealth. Bracket creep occurs when inflation raises nominal incomes. As nominal incomes rise, individuals may be pushed into higher tax brackets. This happens even if their real income, purchasing power, has not increased. Consequently, a larger percentage of income is paid in taxes. The result is a reduced after-tax income relative to the pre-inflation purchasing power. Asset owners often see their wealth increase during periods of inflation. Stocks and real estate, common assets, tend to rise in value with inflation. This increase in asset value benefits those who own these assets. However, this benefit can exacerbate existing wealth inequality. As asset values rise, the gap between asset owners and non-owners widens. Financial repression can exploit the dollar's position as a global reserve currency. This exploitation effectively imposes a tax. The tax primarily affects foreign entities holding U.S. treasuries. This taxation occurs through the devaluation of the dollar. Devaluation reduces the real value of these holdings for foreign investors. Real returns are turning negative, impacting the attractiveness of dollar-denominated assets. Negative real returns incentivize investors to seek alternative investment opportunities. This leads to increased diversification away from the US dollar. As diversification accelerates, demand for the dollar decreases relatively. Reduced demand contributes to a gradual erosion of the dollar's dominance in global markets. The decay of dollar dominance is a long-term trend influenced by shifting economic conditions. The existing $38 trillion debt will undergo a process of dilution and reduction. This debt will be transferred from the public balance sheet to private savers. This transfer will manifest as losses for individual savers. The process marks the beginning of a significant devaluation of assets.